Good evening and welcome to Your Money, Your Call. I'm Chris Kimber. Joining me on the show tonight are Kim Slater from County Securities and Roger Montgomery from rogermontgomery.com. If you've got a question that you would like us to answer about shares, our phone lines are open right now on 1300 30 34 35, or if you prefer, you can email us on yourmoney@skynews.com.au. Welcome to the program. Now, we might start with you, Roger, to see what you've been up to. I can see you've got Keep Calm and Carry On
I'll carry it with
in
me
front of you, which is it's probably pretty appropriate for the last week. Have you been keeping calm, and what have you been carrying on with?
Oh, absolutely. Look, we've been continuing to accumulate the companies we like, the A1 businesses that are trading at discounts to intrinsic value. We've been accumulating those. We remain only about 38% invested. We were 10% invested in April, so we've been adding to our holdings as the market has been falling. On a much more serious note, I think what we're seeing is one of the worst types of crises. It's a crisis of legitimacy, whether it's in the United States as the Republicans and Democrats fight over how to actually fund their budget black hole, whether it's in Germany as they fight over what to do in Greece, or even Japan, which it might surprise some viewers that in Japan there's been 6 prime ministers stepped down in the last 5 years. So we've got a real lack of political will, and where that occurs, where there's political uncertainty, you get obviously market uncertainty, and that's increasing the equity risk premium. Now, what concerns me is that over the next 12 months, despite the fact that stocks are cheap, they may get cheaper simply because the equity risk premium expands. So the willingness of buyers to actually buy becomes, I guess, less. It's not as entrenched as it has been before. It may be just a little bit too early yet. So we're seeing some bargains. We're buying anyway. Don't listen to my macro view of the world to make your investment. Don't listen to my macro view of the world to make your investment decisions. We're still buying, but we're buying at a slothful rate.
Yes, yeah. All right. Go to David from Noosa. Hi, David. What's your question for us tonight?
Yeah, hi guys. I'm just interested in the panel's opinion on Computershare, please.
Yeah. Okay, thanks very much for your question, David. Computershare there, probably a little bit leveraged into the market, under pressure like a lot of other stocks there at the moment. Roger, does that make your list? I know Computershare is not in our portfolio.
It's not one that I own. Having said that, though, it's a business that I know is trading at only a small discount to its intrinsic value. It's trading about a 4% discount, so I think it's worth, it's trading about $7.16 or thereabouts. I think it's worth about $7.40. It's an A3, so, as you know, I rank companies from A1 to C5. So it's an investment grade company. This is a business that any broker, anyone in the market knows is, as you rightly pointed out, leveraged to the market. So if the market turns around and rallies significantly, well, so will Computershare. I'm not one to be able to predict whether that's going to happen or not. And so I need bigger discounts to intrinsic value before investing in a company like Computershare. Having said that, it's got terrific competitive advantages that I don't think have been eroded recently by their competitors, despite various attempts. So I think it's got long-term prospects that are bright, but it isn't cheap enough.
About how you would go about quantifying risk associated with a financial crisis in Europe, and if that's really relevant, because I know that.
It is relevant. No, you're right, William. Yeah, sorry.
I think the quick answer to that is how long is a piece of string?
The reason we were laughing, William, it's a very fair question and it is relevant. It's just a very difficult one to answer. I'm going to throw to Roger here, but first of all, look, Fairfax as a stock, I mean, we've been avoiding for some time, and even though it's cheap now, I think there's 20 other things to buy. But Roger, what would you do?
Well, William, you've done a discounted cash flow model, so that means you've used a discount rate, I assume, to get the present value of those cash flows. How did you arrive? The question is, how did you arrive at that discount rate? And obviously, you've got to factor in what you believe is the percentage chance of Europe imploding or the US dollar collapsing and the impact on markets of that into your discount rate. Now, as was whispered here, how long is a piece of string? You don't know. You don't know how to actually factor in that number, and there's no precise way of doing it. Ultimately, what you're doing is estimating the value of something. My value is a little bit less than yours. I actually have a value of 53 cents for Fairfax. one of the big risks for Fairfax is company specific, and that is that they carry a lot of goodwill on their balance sheet. Now, that goodwill is the result of the acquisitions that they've made in New Zealand, and given that they're only generating a return on equity of 2 or 3%, I don't know how auditors can justify the carrying value of the assets on their balance sheet. That suggests to me that there's probably more write-downs to come, and I've been saying that now for 3 years, and I think there's more write-downs that are necessary on the goodwill that's on the balance sheet.
Yeah, look, I think that's some good comments from Wakery. Hi, Stan. What's your question for us tonight?
Good evening, gentlemen. I'm interested in involved with M2 Telecommunications.
Yep.
And I was just wondering if you guys could tell me if it's a good time to get into it now, if I wait or what.
Yeah, listen, Stan, thanks very much for your question. I think you might have picked one of Roger's stocks. I think that might be one of yours. Roger, is that right?
We do own it in the Montgomery Private Fund. We think it's worth considerably more than where it's trading. We think its prospects are fantastic. We've met with management on several occasions. We like this business. This is an A1 company with terrific prospects. It's trading at a discount, substantial discount to its intrinsic value. We think it's worth about $3.56, despite the fact that it's trading at about $2.96. So in this market, there aren't many A1, A2 businesses trading at discounts to intrinsic value despite the falls. This is one of them. They are born salesmen. They make no bones. They don't hold back. They say that they are a selling organisation that happens to have telephone plans and internet plans on the shelf. And from management down, they are born sellers and they do a great job.
Roger, do you use stop losses?
I have a career built on trading systems. I used to build automated trading systems, which back then we called clickers, now they're called trading robots.
Right.
And at one point I was the biggest trader in the Hang Seng and Nikkei futures contract in the world.
Yeah.
I've never found a stop loss method that worked consistently. You know, so if you're, look, and no offence to Kim at all, a stockbroker, and there was one who wrote in the paper on the weekend about the importance of stop losses, would naturally advocate the use of a stop loss because
create a few more trades.
Exactly. But in the past, well, in the past I've used them, and they're great because they keep you out of collapses. By definition, they're going to do that. They're going to get you out at a 5% loss, or you're going to use a volatility-based stop loss, and they're going to get you out. I've never found one that predicted correctly when the collapse was going to be big, and separate that from the one that was going to be small and would ultimately reverse. And for that reason, I don't use them. And a lot of research that we did, we built trading systems that worked really well. They made a lot of money, and when we tweaked some of the parameters, they made even more. But then when we stood back and we compared it to a buy and hold strategy, we found that a buy and hold strategy outperformed because there was less commission being paid out. So if someone can tell me the method that they've got for a stop loss that works consistently across all markets and across all volatility and all cycles, you know, I'd be delighted to hear it, but I've yet to find one.